This is Greg Trotwine with Maritime Logistics Professional, and we're here today with Peter Sand Xeneta to discuss the ever-changing container shipping market. Peter, it's always great to have you back, and I'm sure the tumultuous world of container shipping continues to keep you and your Xeneta colleagues running at full tilt. Obviously, the degradation of international relations has and will continue to impact the container shipping business. How do you see the trade patterns taking shape today?
It's always been the case of a massive discussion in the industry whether to reshore, nearshore, or whichever term you put to it. Right now, topic of or term of the day seems to be friendshoring, but it all originates, of course, from sovereign nations not necessarily agreeing on how to run the world. And from a U.S. perspective, some Xeneta numbers indicate that American manufacturers, at least those that make investments in the Far East, have put money where their mouth has been, at least for a number of years, because they are gradually, slowly untackling themselves from being overly reliant on China. Let me give you some numbers here, Greg, just to put it into perspective, because in 2017, 5 years ago, approximately, 2/3 of American imports from Asia originated from China. Today, that's down to 56% only. And the winner in this game is obviously Vietnam, for those of you who have followed it quite closely. Vietnam used to take up 6% only of US Asian imports, and it's now at 11%. Obviously, it's a massive investment, not only from the manufacturers and those that needs to update and change their supply chains, but also the port infrastructure, warehouses, etc. But my point today is that whatever term or how you coin it, it's an ongoing topic, and I would say so more than ever going forward that the geopolitics of the world will also reign and change global supply chains. So watch out for it.
I noted with interest that in April, we've seen the most significant fall in rates on the westbound transatlantic trade lane since prices started moving downwards in May of last year. What's happening there?
It's still the one of the main trades that defies gravity. It hasn't been hit to the same extent as literally all other main hauls around the world by being all but back at pre-pandemic level. Right now, we still see elevated levels on the westbound trade of transatlantic. But the one thing that is changing right now, at least the pace of the decline, is that of capacity. Carriers seems to deploy, at least according to Sea Intelligence, 25% more as compared to mid-March last year. So obviously that have also impacted a trade where demand is falling at a lower extent than the rest of the world, if you also go by the most recent numbers for global trade, but still it's coming down. And when you have too much capacity set into a trade where demand is also declining, obviously the result will be lower freight rates. Still, I guess roughly 100% above pre-pandemic levels, so there's still ample room for declines on that trade. But watch it out. Watch out for any changes on that key trade lane, because I think to me it's also very relevant to see where things are still a little bit strange coming out of the COVID years, and not all back to basics in whichever new form it may take also.
I think a little bit strange could be the mantra for 2023 and beyond. There's a lot of strange things happening, that's for certain. So
very much so.
Peter, I very much appreciate your time. I had one more question, and with this, I wanted to switch coast and look at the U.S. West Coast. The U.S. West Coast, as you well know, has been the traditional power in the U.S. container shipping market, and it's fallen on some hard times for some various reasons. How do you see rates shaping in the Trans-Pacific trade, both short-term and long-term?
I think it's one of the bellwethers of our industry because of the significance and importance of the U.S. West Coast imports. I mean, if we look beyond still the labor disputes and the negotiations between ILWU and PMA, which still haunts the market and gives shippers and carriers a tough time still and sleepless nights. What we have seen most recently has been a successful initiative by the carriers. They used to announce these general rate increases, and by mid of this month, April, we've actually seen them significantly push up China to U.S. West Coast rates from being at 1,200 per FEU to 1,700 per TEU. We have also seen the long-term rates inch up on top of that gradually. So it may just be the fact, at least for now, we have seen that part of the market bottom out, still at loss-making levels for the carriers, but at least it's some improvement that you move up $500 and not dropping those on the floor 5 days later. It's been at least 2 weeks now for that, and we will see more of that going forward. Also, carriers trying to lift the lows of the trades for them, also going into another round of negotiations. As we know, it's not only leading up to TPM, it's round year that you need to time your negotiations. And if you have higher and stronger spot market rates, you will also, as a carrier, be able to pass some of that on. Of course, the flip side of it, shippers should, of course, always make sure that they are armed with the best possible data going into whatever negotiation they like, and of course be sure that they also compare and benchmark their own performance and check out whether they should go with one carrier or the other. And TPM, I think, the change that we have seen in the most recent weeks, I'll keep a keen eye and look towards any changes on that, and I'm sure we will talk about that also shortly again. Greg, I shall be happy to brief you as always on our insights on that key trade lane.
Okay, well, Peter, as always, spot on and concise. I appreciate your time, and I look forward to catching up with you again.
My pleasure. Thanks for having me.